Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 334 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including bullishness for 2026 amongst the forecasting crowds, biggest risks to the market this year, sentiment improving, U.S. jobs updates, and whether people should be making pre-tax retirement contributions or after-tax Roth contributions. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. So good morning, Matt.
Morning, Mark. How you doing, man?
Good. A little chilly this morning. Some unexpected snow last night, but I guess that's par for the course in middle of January here in Dayton, Ohio.
I think it pretty much is.
Yeah.
You don't know what the weather's going to be like day to day. Could be 60 in shorts. Could be 22 and you need a parka.
Right, exactly.
It switches in 24 hours.
Yeah, it's true. But anyways, moving into the numbers for this week's show, this data is from Y Charts, and all of these numbers are as of the market close on January 14th. S&P 500 index is up 1.2% for the month, and obviously 1.2% for the year.
Who would have guessed that with all the headlines year to date, by the way?
Still in January.
Who would have guessed that?
Dow Jones Industrial Average up 2.3% for the month. The NASDAQ Composite Index up 1% for the month. The Russell 2000 Small Cap Index leading the way at up almost 7% already for the month.
Come again?
7% for small caps. And then lastly, the Vanguard All World X United States ETF, another strong start, up 4.1% for the month. 3-month Treasury rate at 3.67%, the 2-year Treasury rate at 3.51%, and the 10-year at 4.15%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. Well, I mean, if you saw all the headlines, if I just gave you a printout, the average investor of all the headlines that have occurred in the first half of this month, and I said you have a choice, do you think the market at that point is up or down for the year? I would argue 80+% of respondents would say what, Mark?
Yeah, that is down.
Down.
Yeah, that's the funny thing about markets, right?
And I got a very quick hot take. The fact that the market is up in the face of these headlines, you need to be paying attention to that.
Yeah.
Just want to throw it out there.
Yeah, for sure. Yeah, there's been, I feel like I can rattle off 10 different things that you would think would have a negative impact on the market, and we just haven't seen it so far.
However, I do have a spot about intra-year volatility coming up that I think is going to be very important for our listeners and viewers to remember.
Great. Moving on to big headlines and current events. Jobs report numbers from December were released last Friday. The December non-farm payrolls rose 50,000, which missed expectations for an additional 66,000 jobs. But the U.S. unemployment rate fell from 4.6% to 4.4%, which was better than estimates. And next, Matt, is mentioned in last week's episode. I wasn't on the show, but I think it was you and Nick. If my memory serves me.
Yep. Jenna's nodding her head. Sometimes these podcast weeks blend together.
Yeah, I was like, was he not on the episode?
Looking gently towards Jenna for the confirmation, looking back.
But anyways, you guys talked about the Santa Claus rally a little bit, right? And how it failed to show this year. And again, the Santa Claus rally tracks the last 5 trading sessions of 2025 and the first 2 trading sessions of 2026. And again, it did not result result in a net gain for the S&P 500, which means there was no Santa Claus rally for this year. However, another important indicator for future market performance, the first 5 trading days of January were positive.
That's a hot one, by the way.
By more than 1%. And Ryan Dietrich shared some stats on X on January 8th that shows when the first 5 days of January are up by more than 1% for the S&P 500, like it was this year, the full year is higher 87% of the time for an average gain of almost 16%. And in addition to that, the NASDAQ 100 was also positive during the first 5 trading days of January, the tech-heavy index. And Subutrade on X shared data that shows when this happened in the past, the NASDAQ 100 has finished the year higher about 93% of the time with an average gain of over 25%.
There's about 20 data sets on that one, by the way.
So even though Santa failed to come this year, it's not all bad news.
No, it's not. And another important data point that I think people are going to be watching is how just the month of January goes. I know we got 2 weeks left, a lot of potential
January
headlines.
barometer, so to speak.
January barometer.
Which the first 5 trading days of January and the January barometer have more data behind it, that if those are positive, even if the Santa Claus rally is negative, it tends to be better for markets.
Yeah, well said. And for newer listeners and viewers, as you're listening to the podcast, Mark and I will tend to kind of look at the lens of history when certain things happen in the market. And this is an example of that. Should this be a data point that causes an investment decision? No, but I think these are the components that go into looking at the market, whether it's sentiment, the underlying fundamentals. Seasonality is one of those things.
Yeah.
And so it's definitely important to consider these points, in my opinion.
Right. Lastly, with news headlines, the Supreme Court has not issued a ruling on President Trump's tariff authority yet, as some had expected. So we will continue to keep an eye on that. And I think this is just one of those funny things, Matt, where, you know, if I'm on X or, you know, reading news articles and you have someone say, you know, I spoke with a source close to, you know, blah, 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 that this is going to be the outcome of what the Supreme Court decides. And here we are 2 weeks later and they haven't even talked about it yet. Right. So I think it just, I wanted to point that out because in our industry where this comes into play is like forecasting, right? You have these respected Wall Street analysts that are putting out their forecast for 2026. And it just goes to show you, like, it really doesn't matter. And you can't always believe what you see and what you hear. Because I fell into this too the night before. I think this was 2 weeks ago that they said that the Supreme Court was going to rule on it. I sent you a guy that we both follow that is pretty reputable and shares good information. And he said, I have a source close to this that says this is going to be the outcome. And here we are, still nothing, right?
Very accurate statement.
So just thought that was interesting. But I think you mentioned in July, there's something in July that there needs to be a ruling on.
There's the USMCA has to make a decision on July 1st. And this has been on the docket now for years, not just because of the administration's viewpoints on tariffs. So what's going to happen is this is going to be a talking point, I think, especially in the spring, how the U.S. renegotiates this topic with Mexico and Canada. And right now, things are not going very well, I would argue, for Canada in this negotiation process. So it'll be very interesting the closer we get to July 1st.
Yeah, so some are speculating that it's going to be pushed back until this summer, which I think is probably the best case scenario for the market at this point in time.
I would agree with that statement.
Yeah. Moving on to tweets, articles, and research from this week. First thing I had was a Substack post from Duality Research on January 5th titled Bullish with Eyes Wide Open. So they shared some good information here, but the thing that stood out to me was their comments about Wall Street analyst predictions for 2026. So I just want to read this paragraph. They said, while year-end targets are mostly useless, which I agree with, they can still give us a sense of how people are feeling. Right now, Not a single one of the 21 forecasters surveyed is predicting a decline. That tells us one thing: the market is feeling pretty bullish. Normally, a crowded consensus like this might be a warning sign, but we're holding off on calling it a contrarian signal. Unlike when everyone's bearish, you can't always bet against the bullish crowd. After all, for most of the cycle, the crowd is the market. Case in point, 2025, every strategist expected a rise, and that's exactly what happened. So it was kind of the similar scenario going into last year, and we all know that 2025 was a good year for stocks, but it always does just give me pause sometimes where it's like, okay, everyone's on the same side of the trade. What are we missing here?
Great point. My 2 cents, and I have a piece on this here in a second, is talking about market sentiment and bullishness has just been back into an optimistic territory just recently. I would feel differently if we were coming off of multiple year optimism. But let's face reality, and the hot take is Wall Street messed up last year. They got way too conservative after April, and they were underperforming most of the year. That's how the year went. Let's call it for what it is. And now they're starting off the year more with a bullish slant. And again, if they were coming off multiple years of it, I would agree with the contrarian aspect of it. It's not there yet.
Yeah. Next thing I had was a chart from Deutsche Bank showing the biggest risks to the market in 2026. So
this will be fun.
So Deutsche Bank surveyed people to understand what they are most fearful about regarding the market this year. And just want to go over a couple of these, and you'll be able to see this.
Maybe they listened to my podcast last week.
Yeah, they could have. Very well could have. This will be on our show notes and on the YouTube video. But as no surprise to everybody, 57% of respondents said that tech valuations plunge and AI enthusiasm wanes is, the biggest risk to the market in 2026. Next, shortly followed by the new Fed chair pushes for aggressive rate cuts. Crisis in private capital, bond yields rise more than expected, central banks hike unexpectedly, AI causes noticeable impact on unemployment and markets extrapolate that. Bank of Japan hikes rates significantly, turmoil in crypto assets, and a U.S. hard landing. So there's fears of this magnitude every single year, right?
Oh, yeah.
And my takeaway from this is if and when there is a sell-off in the market that's more than just a 5% correction this year, my money would be on it's due to none of these options listed in this survey.
So accurate, in my opinion.
We'll have to wait and see. Like we talked about before, typically in midterm years and in 2026, the data shows there might be some weakness in Q2 or Q3. So if we do get that, I'd be interested to see what the, quote unquote news headline that's driving that sell-off.
Great point. And remember, in these midterm election years, slice and dice the market by the 4-year presidential election calendar, the intra-year volatility, high point to low point, is over 17% sell-off. That's normal.
Yeah.
That's normal.
Yeah, we had that last year, right? What the drawdown last year was 19%
on a closing basis on the S&P.
And the S&P finished up 16.
Right.
So
did he look at my show notes ahead of time, Jenna? He's on it. He's on it, baby.
Last thing I had before turning it over to you is a post on X from the Market Stats on December 5th of last year. So they show a chart of the University of Michigan Consumer Sentiment Survey. So for those who might not be aware, the U of M Consumer Sentiment is a monthly survey that measures how confident U.S. consumers feel about the economy, both now and in the future, based on their views of personal finance, business conditions, and buying conditions. And it really tells us how optimistic or pessimistic consumers are, which matters because confident consumers tend to spend more and worried consumers tend to pull back. And we all know how important consumption is to the U.S. economy. Mm-hmm. So what this shows is a chart of the S&P 500 and all instances when the University of Michigan Consumer Sentiment Index is below 56. And it shows forward performance for stocks. And what do you know? 1 year later, stocks are positive 100% of the time and up on average almost 18.5%. And again, the last time the U of M Consumer Sentiment Index fell below 56 was just last month in December. So pretty small sample size. We're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 instances. So not huge, but again, kind of another nice contrarian indicator that we've talked about several times before on the show, but I just thought that this was a nice chart that kind of summed it up. So again, even though we're in a midterm year, I just shared some data that could lean on the positive side of things, and maybe it's not going to be a typical down or flat midterm year.
That's a good point. I think that these sentiment surveys have not been as accurate the past 5 years since the pandemic initially hit in 2020. And it's interesting to see over the past 5 years, it appears to me the mode of operation when they do these surveys is people answer them as if things are horrible. But then when you look at the spending activity, which I have a piece on here in a second, our notes are going to mesh perfect. It tells a different story.
Yeah, it doesn't line up.
Yeah, interesting.
It's kind of like, again, using it in our industry, it's like when you have a money manager that's on CNBC saying one thing, but then you look at their portfolio and it says another thing. It's like, okay, there's a disconnect there.
There's a disconnect.
Right? We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
All right, my first piece is going to be about market sentiment improving. So I'm going to be referencing an X post by the Market Stats on January 10th. And before I get into it, it's going to be referencing what we call the AAII Sentiment Survey. For a lot of the podcast longtime viewers and listeners, they've heard me reference this from time to time. For our newer viewers and listeners, the American Association of Individual Investors does a weekly poll. And what it does is it gauges the mood of individual investors towards the stock market. It asks participants whether they feel bullish, bearish, or neutral. It's a single question with 3 possible answers. And that has to do with their mood and feelings of stocks over the next 6 months. This survey was launched in July of 1987 and has been running continuously for nearly 4 decades, providing one of the longest running measures of retail investor sentiment in the U.S. The survey results are based on voluntary responses from AAII members and are often used as a contrarian indicator with extreme optimism or pessimism, potentially pointing market reversal points. Having said that, when you look at the data, when I saw this X post from the Market Stats, sentiment is improving. For the first time in over a year, Mark, the AAII bulls outnumber bears for 6 consecutive weeks. This historically occurs after bear markets, and the S&P gains on average over 17% the following 12 months. The data set is not deep on this. The data set, for the record, 1991, 2010, after 91, you had the Gulf War. 2010, what happened before that? The great financial crisis. 2023, what happened before that? 2022 was a horrible market for stocks and bonds with hyperinflation. And then you got now. So going back to what we were talking about in the podcast earlier, you've had a lot of negativity about the market, but people just now are starting to get more optimistic and bullish. It's not like it's been this way for a year. This is a new phenomenon. Your thoughts and comments, I'm just throwing out the data. Your CIO thoughts.
Yeah, I think when we see things like what happened in 2025 with the tariff-driven sell-off in April, and I think you point this out a lot more than I do, is that it takes a long time for people to get comfortable with investing in the market again, or their opinion on the market after something like that happens, right?
Good point.
And typically, as to steal, a quote that you always reference, is that the easy money is already made at this point, right?
Yeah. Yep.
So this is interesting data showing that, hey, this could still continue to rock and roll for another year. But, if you were out of the market, like you said, from, April of last year through the fall of last year, or even up and until now, you missed out on some pretty significant gains in the market.
Yeah, and if someone tries sitting there and saying to me, but Matt, there's not enough cash out there to bid stocks up, I have a lot of data points to push back on that.
Yeah.
You now have the average household in North America, 7% of their assets are sitting in cash. It's the highest level, and I talked about this on the podcast over the past month. That's the highest level going back to the 50s. You look at it, you got over $7.5 trillion sitting in money markets. You look at flows between the asset classes last year and 2025 between cash, bonds, and stocks. Stocks got the lowest flows. So again, the data is not backing it up that everyone's fully committed to stocks. I just want to throw that out there.
Yeah, and I think it's just, again, it's the world we live in with, us having access to every single news headline at the tip of our fingers with our phones and on our computers and on the TV. And it's like we get information so quickly and it's all so negative, and people are just worried constantly because they're getting fed this information that the world is going to blow up.
That's right.
So I think that could be a contributing factor to those high cash levels as well.
Goes back to the animal instincts of the market, two guiding emotions, fear and greed.
Yeah.
Right. My second piece has to do with an update on the American consumer. Again, this will mesh well with some of the points that you brought up to our listeners and viewers. This was, help me pronounce the name of the letter here. I always mess it up.
The Kobayashi letter.
The Kobayashi letter.
Which I have my own feelings about, but continue.
They tend, this is not a judgment, this is my opinion. They tend to play the fear aspect of the market. So this is a post that they had on January 9th. I'm going to read through this. It says, U.S. holiday online shopping, they shouldn't use the word surged, but I'm going to read it verbatim, surged 6.8% year over year to a record $257.8 billion. That's between November 1st to December 31st of 2025. This marks at least the sixth consecutive annual increase. There were 25 days where daily spending exceeded $4 billion, up from 18 days the previous year in 2024. Cyber Week sales alone jumped 7.7% year over year to a record $44.2 billion, with Cyber Monday sales jumping 7.1% year over year to $14.3 billion. Mobile shopping accounted for over 56% of all online transactions, and that got as high as 66% on Christmas Day. Furthermore, buy now, pay later spending rose 9.8% year over year, to $20 billion for the first time. Meanwhile, traffic to retail sites from generative AI tools surged. This is appropriately used, the term surged, 693% year over year as consumers used AI shopping assistants to find deals. So I want to throw that out there. When you look at this, this chart will be in our show notes. Jenna will put this in there. She can put it up for our YouTube viewers. This is showing that holiday seasonal spending, and it goes back the data set to 2019. The source underlying here is Adobe Analytics, and you can really see the consumer right now from a holiday spending standpoint, these are not bearish data points.
Yeah, and before you make your next point, the only thing that I want to say here is, you've had people questioning why the U.S. hasn't gone into a recession over the past 2 years, and you could just look at this chart and figure out the answer. People are still spending, right?
Well said. Well said. So as Mark was talking about earlier, the sentiment survey by the University of Michigan, not the most optimistic, let's just say results from that survey. But when you go my point earlier and look at the actual spending data, I'm not saying it's a full 180, but it's pretty close to it.
All right.
Let me continue. So another item I saw on this same wavelength was a post by Kyle Potter. He's the editor of something called The Thrifty Traveler. It's a podcast talking about traveling. And this is what Kyle mentioned. Crazy stat from Delta's 2025 earnings this morning. Again, this is not going to be a recommendation from Mark and I for or against Delta. But the airline posted a $5 billion profit despite selling 1.1 billion less in economy tickets than they did in the year 2024. Because premium ticket sales made up the difference. Says everything about where the money is in travel right now. Your thoughts, Mr. McEvely?
Yeah, I saw this too, and I thought that it was really interesting, but I think it just goes to show that high-end consumer can continue to carry this economy a lot further than a lot of people think.
Yes.
So
for our newer listeners and viewers, I'm going to throw out a stat that I talk about a lot. I know you do as well. We gotta actually realize that the top 10% of income earners in the U.S., which is going to be labeled as household incomes of at least $250,000 or greater, now make up 50% of the total consumer spending in the U.S. And the fact, in my opinion, that group is doing well. They're spending, and that is providing, let's just call it, the backbone of the consumer spending. And are there other consumer bands, especially on the lower end, that I think are still stressed post-pandemic? Yes. But we got to, I think, be realistic and say what is driving the economy right now. And data points like this are just confirming what I've already been thinking.
Yeah, for sure.
All right, let's talk about market volatility. This is a blog post by Ben Carlson, on January 6th, Mark. And he titled the blog post, "It Happened Again." And this has to do with market volatility. And I want to hit this home because I know you agree with me on the statement I'm about to make. I do feel that this year is going to exhibit a lot of intra-year volatility. Do you agree with that statement?
I do.
Okay, so let's go through this. Ben posted on January 6th, the S&P 500 was down nearly 20% from the highs at the Liberation Day lows in early April. He's talking about April of last year. The index was showing a 15% loss for the year as of April 8th. From the lows, the market took off like a rocket ship, rising almost 40% from there through year end. The S&P finished 2025 with a gain of almost 18%. To recap, there was a peak to trough drawdown of around 19%, but the market still finished the year up nearly 18%. A double-digit gain despite a double-digit drawdown. One of my favorite aspects of the stock market behavior is that this kind of thing is perfectly normal. Perfectly normal. Jenna's going to put up this illustration for our YouTube viewers. This piece will be in our show notes. What this piece illustrates, and it's titled "Volatility in Stocks is Historically Normal in All Years," it shows in red what the annual return was for the S&P 500 index. Then what it shows underneath those years in kind of in gray is what the max intra-year drawdown was. I'll continue. Ben wrote, "The same thing happened in 2020 and 2023 as well. However, this is not just a 2020s phenomenon. Of the 36 calendar years since 1990, 21 have had intra-year peak-to-trough drawdowns of 10% or worse. Of those 21 years, only 7 ended with a loss on a total return basis, meaning 14 times the market finished in positive territory. And 11 of those 14 years in the black experienced double-digit gains. That means roughly 40% of all the years since 1990 have gone through double-digit drawdowns, have finished up more than 10% for the year. The stock market has a remarkably ability to produce both gains and volatility in the same year. Of course, this doesn't happen every time. In 2000, 2001, 2002, 2008, and 2022, there were double-digit drawdowns, and the market finished the year down double digits. This is one of the difficult parts about investing in the stock market. Most of the time, it comes roaring back from the big losses, but other times, it takes a little while. There will be times when the stock market will test your patience again in the future. And I don't use this word very often. I guarantee that. You have to survive short-term and long-term volatility in the stock market to earn your just rewards. Mark, your comments.
Yeah, I mean, when we've shared, I don't know how many variations of this chart over the years, but for anyone, that at least we start working with, and just for advisors in general, I think this is a good chart just to kind of level set with people. That's like, hey, this is the S&P 500 going back to 1990 with the corresponding returns and the corresponding intra-year drawdowns.
Yes.
So when inevitably we have another drawdown where markets are down 10, 15, or 20%, I'm going to reference this chart during that time. Now, you're going to have emotions flowing through you that you don't have right now.
Well
But
said.
this is a really good chart to come back to if you are in a position when the market's going nuts and you have this something in you that wants to sell all of the stock that you have, right? And then you just look at this chart and you're like, oh, like you said, this is normal.
This is normal.
This is not the last time it's going to happen. It's going to
Not the
happen
last
again. But you have to have trust in your advisor or trust in yourself if you're managing your own money, that you got to stick to your game plan, right?
Yeah, I'm going to be a fortune teller. My fortune teller is at some point as the year goes on, we're going to have, I think it's likely at some point we have at least a 10% plus correction. I'm going to reference, hey, for our regular listeners, remember back in January when I talked about intra-year volatility, and I'll go down that road. This is a year when you slice and dice the 4-year presidential election cycle. Remember how I talked about this has the largest intra-year drawdown? It also has the largest intra-year rally.
Yeah.
So we got to remember that volatility in years in these midterm election years is par for the course.
Yeah. It's like a rubber band, right? If it snaps
One way.
too far in one direction, snaps back pretty strong in the other direction.
Correct, sir.
Yeah, great piece.
Thank you.
Last thing I had was for our financial planning topic of the week. It was a blog post from Mike Piper at the Oblivious Investor on December 22nd of last year. And we've talked at length, Matt, before about debating whether people should be making pre-tax retirement account contributions or after-tax Roth contributions.
Okay.
And often I find that investors focus on their current tax bracket a little too much to determine if they should be making pre-tax or Roth contributions. But Mike makes a great point in that people have to also consider what their retirement account balances already look like, as that should be a very, very important consideration in the decision-making process. So I want to give 2 examples here just to give listeners a taste about how we think about this, right?
I'm in.
So example 1, you have a married couple filing a joint tax return in the 24% tax bracket with most of their income coming from W-2. Example 1 couple is 60 years old and has been maxing out their pre-tax retirement accounts for 30 years and has a balance of about $3.5 million in those pre-tax retirement accounts. Example 2, similar to example 1, it's a married couple filing a joint tax return, 24% tax bracket with most of their income coming from W-2. Example 2 couple is 35 years old and has been making Roth contributions throughout their careers up until this point. So they have a large Roth retirement account balance, but nothing saved in pre-tax accounts.
Okay.
So both households are in the 24% bracket, so they each get the same amount of tax savings this year from making deductible and pre-tax 401k contributions. But example, one couple with their large pre-tax balance are already going to have a significant amount of taxable income in retirement, which makes Roth savings start to look a little better. Example, two couple will have almost no taxable income in retirement if they continue along the Roth only path. At some point, it makes sense for them to start making tax deferred contributions so that they have income to, quote, use up their lower tax brackets in retirement.
Ooh, that's juicy.
Because we have to remember that most people and couples take the standard deduction when they're filing their taxes, right?
Correct,
Which
sir.
for 2026 is $32,200.
Yes.
Which means you can take $32,200 out of your pre-tax 401k or IRA
And pay how much in taxes?
zero, right? So to take advantage of that, you got to have some pre-tax income, right?
Bingo.
Okay. So again, this is just another kind of look at the pre-tax versus Roth contribution decision, just to show that it's not just based on your age or how much money you make now, but also what you already have saved up until this point. And I can make an argument that, taxable accounts even play into this decision for some people.
It was interesting. I was given a presentation yesterday. Jenna was on it. It was a presentation regarding a company's stock purchase plan that they offer to their teammates. And at the end, I took some questions. And one of the questions was, Matt, should I be contributing to my 401k? A different topic, but it was okay. Should I be contributing to my 401k pre-tax or after tax? I thought it was interesting. So this is definitely a topic that is front and center, especially at the beginning of a new calendar year.
Yeah. And as a reminder, I think it's, just how people diversify investments. You need to diversify your tax liabilities when you're starting to think about income in retirement.
Well said.
You should have some pre-tax or tax deferred money, another name for it. Some Roth, zero tax money, and then a taxable brokerage account, which is not a retirement account, right?
Yes.
You can put as much money as you want in there every single year. If you sell something, you have to pay capital gains taxes. But if you have those diversified income streams along with, Social Security, a pension payment, maybe an annuity in retirement, it allows us as an advisor and you as the client to manage your tax liabilities a lot more efficiently in retirement.
I have nothing to add. It's perfectly said. You'll have years where you might need some excess income to take care of life, whatever that looks like. And if you have more tax source buckets to manipulate whatever the tax code looks like at that point, it's going to put you in the driver's seat to minimize that bill.
Yeah, for sure.
Well said, Mark. Before we kind of sign off, why don't you give kind of an update where we stand with the calendar and some of the topics people might be noticing over the next couple of weeks?
Yeah, so obviously the big one is earnings season. So banks got started reporting this week. Their numbers look to be fine, but the reactions in the stock price have been pretty bad this week. So JP Morgan, Bank of America, for example, I think a lot of that has to do with the conversation of capping credit card interest rates that Trump and his administration have talked about over the past few days. So that's not helping things.
Yep. And those stocks have run up into earnings, I would argue, too.
True. And then obviously the next couple of weeks, we're going to continue to kind of ramp up until we get to, late January, early February. We start to get a lot of the heavy hitting tech names that we usually talk about every quarter that are going to start to report earnings to see really how the market is doing from an earnings and valuation standpoint.
Yeah, and even some of those companies might give us 2026 full year outlook estimates. Not all do, some do.
Right.
And the earnings that most of these companies are reporting are for the fourth quarter. Two more comments. I mentioned this on last week's podcast. I think it's very likely the government gets shut down sometime in February. The funding for the latest continuing resolution funds the government through January 30th.
Yeah, good point. A lot of people probably forgot about that.
Yep, it was fun. I was going to grab Chipotle last night with my wife, and I was like, hey, one of the things I want to throw out there in February, you're going to see most likely another government shutdown. Yeah. She was unaware that the continuing resolution only went to January 30th. I think a lot of people are unaware of that. Second factor is you're going to have a Federal Reserve announcement at the end of January. I would be shocked to see a cut at this upcoming meeting, but that is going to be another headline, let's call it, that I think you're going to see in a couple of weeks.
Yeah, good point. Well, thanks everybody for listening to episode 334 of the Independent Advisors Podcast. Catch us next week for episode 335.
Thanks, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.